What's up, opportunity cost investors? In case you can't tell, I'm really happy to drop this YouTube video because if you're anything like me, your YouTube channel's been blown up with stimulus package updates 7, 8, 9, and 10, which brought me to ClearValue Tax's YouTube channel, which I'll link in the description below. Before I dive into analyzing the portfolio, I just want to say that Brian of ClearValue Tax puts out high quality and concise information on personal finance and taxes, which brought me to his channel. When I saw he dropped a video that was titled "Are we up 718%?" not only was it a break from the stimulus, but I was like, man, this is such clickbait. I had to check it out and see if it was for real. Now I'm watching his YouTube video and I'm hearing him break down his portfolio, and again, I'm hearing not all the information that we need to evaluate his performance.
In our $100 stock accounts, we are up. In our $500 stock accounts, we are up. In our $10,000 crypto accounts, we are up. In our $100,000 stock accounts, we are up.
We're not getting all the information we need, which is becoming a catch line of mine. However, what Brian did that was remarkable and that I don't see YouTubers doing enough is he dropped his spreadsheet, which is amazing because then I can dive right in and do the analysis for you guys and you can see what I think about it and the reason for the title of this YouTube video. Now, before I dive right into Excel, which I really want to do, my YouTube Studio Analytics is telling me that at the moment I go into Excel, it kind of bores most people. So I'm going to give you the straight facts of everything you need to know. And for those people that want to be able to do the analysis on their own, they can dive to the end of the video and they can see the in-depth analysis. But right now, you're going to get the summary. Attention, stock YouTubers. Stop dropping your cost basis. I don't need to see that. What I want to see is your transaction history. I want to know what happened and when. Brian unfortunately dropped his cost basis, so it won't tell us everything, but it'll get us close enough. The next thing I want to point out to you guys is that all four of his portfolios, Webull, Robinhood, KuCoin, and TD Ameritrade, all started on June 16, 2020. As of today, it is July 28th, 2020, and 5 weeks of performance is not enough time to determine his portfolio. 1 month tells us nothing, but I'm still going to break it down for you. Okay, so here's the first mistake, and an important lesson in introduction into a concept I call the intrinsic way to measure opportunity cost. If you look in his Webull and his Robinhood accounts, he's got a row for value added. In his Webull, he added $25, and in his Robinhood, he added $50. Unfortunately, it doesn't tell us when, and I'll show you why that makes a difference. What if he put $25 in this Webull account on June 16th? From June 16th to whenever the spreadsheet was most updated, which I think this one was July 24th, he would have all that time to compound. However, if he only had the $25 on the last day, then he had no time to compound and it was just value added. Unfortunately, even without the date, sometimes I can go in and try to figure out why they included the $25, but because he has such large cash balances on the Webull and the Robinhood account, I can't tell you that he put in the $25 to buy a certain security and try to guess where it would be, but I don't have to. And the reason why is because the intrinsic way to measure opportunity cost. So what you want to do is measure his performance in the highest light possible. And then you want to take the S&P 500, which is what I use for benchmark mostly, and put that in the lowest light possible. And if the S&P 500 still beats out his portfolio, then you can definitively say that his portfolio underperforms the S&P 500. It's called falsifiability, and it's a way to kind of disprove the negative. It's a double negative, and you're saying if it's not true that it doesn't beat, then it does beat. It's confusing, I know, but all you want to do is stack the odds in his favor, and if the S&P 500 still wins, then there's your conclusion, right? So what does all that mumbo jumbo mean? It means that the contributions I'm going to put at the very last day, meaning they had no time to compound, and will give his portfolios the highest rates of return. That way, if the S&P 500 still wins, it is definitive. And that brings us to number 2 on ways to improve the spreadsheet. He could have put the tax implications. There's no considerations for taxes on this, which is unfortunate, and I can kind of see why in his defense. So if I were analyzing this portfolio for him, I would want to look at how his stock picking performance was affected by taxes. A tax-efficient portfolio is going to be better than a tax-inefficient portfolio if the rates are the same. However, he kind of made these portfolios to be a backbone for most people. For example, the $100 Webull account that he has is because if you click on one of his links, you can get 2 free stocks on Webull if you deposit $100. So this is kind of like his recommendation of what to do with $100. And being that it would be someone else's performance in someone else's tax considerations, and see where it affects them differently. But I would still want to see, even on the lowest scale possible, how taxes would be affected. Because if I were telling somebody to put $100 in Webull and this is what you should do, taxes are going to be one of the greatest considerations in that portfolio. Absolutely. It makes a massive difference. You can have anywhere from 0% taxes to 30 or higher. And that's definitely going to make or break you, especially when our benchmark is the S&P 500. And I should add, passively investing in the S&P 500, where your tax considerations are going to be much less significant. Fortunately, and to his credit, his spreadsheet's detailed enough where you can see the gains, any losses, which there weren't any, and the current positions, which is enough for us to do tax calculations. Once we have that information, we can see how it would affect us had we invested into it, or if we wanted to, we can suggest how maybe his tax situation affected his performance. But we're not going to do that. What we're going to do instead is take that intrinsic way to measure opportunity cost, and we're going to say his portfolio made this much percent, the S&P 500 as a benchmark made this percent, which percentage of taxes would be required for the S&P 500 to be the better suggestion. For example, if his portfolio made 100% return and the S&P 500 made 90%, then to go from 100 to 90, it would be 10%. So if his taxable consideration is 10% or higher, then the S&P 500 would have been a better way to go. Maybe even less than that, because you got to take into consideration like time it takes for you to pick stocks and stuff, but I'll ignore all that, of course. And the moment you all been waiting for. I know. Jesse, shut up. Just tell us what we want to know. I got you. And I'm going to do it in the most honorable way I know. ClearValue Tax's Webull account underperformed the S&P 500. The Robinhood account outperformed the S&P 500. The KuCoin account outperformed the S&P 500. TD Ameritrade underperformed the S&P 500. So let's take a moment to dive right into that KuCoin investment platform, because that's where he held Travalia. Now, I was under the impression that this portfolio was going to have Travalia up 718%. I was wrong. The reason is because I believe he has a different portfolio where that investment's up 718%. This specific one actually was closer to 200. And the reason why I believe that is even with creative accounting, I couldn't get to 718%. Also, I believe Brian wasn't trying to mislead people. I believe he's an ethical and morally strong guy. So I just wanted to note that his investment portfolio that's shared in these spreadsheets isn't the one making 718%. And now the moment you all been waiting for. What the heck is this dude's performance? He had a periodic weighted return on investment of 6.43%. Annualized out, that means his performance was 82.25%. Now, the S&P 500 in the same period of time went up 5.66%, or annualized out is 70%. Now, on the surface, it sounds like his portfolio outperformed the S&P 500. However, I need to tell you that these are all pre-tax figures. As I told you before, I couldn't make assumptions on his taxes. So what we have to do now is frame a question and say how much taxes would it take for the S&P 500 to beat him? And then we have to evaluate for ourselves whether we think that's viable or not. So to show you that math, please bear with me because it is kind of complicated. I'm trying to simplify it so everyone can understand, which is a good time for me to suggest you smash that like button for the YouTube algorithm. But I digress. Here's how you do the math. You take the starting balance of $110,600. In 1 year, his current portfolio would have made $91,000. The S&P 500, on the other hand, would have made $77,000. The difference between the two is about $14,000, $13,000. That difference, divided by the gain of his current portfolio, which is $91,000, is equal to 15%. What that says is, if his account got taxed at 15% or more, then the gains wouldn't have been substantial enough to outperform the S&P 500. And this is why I don't believe his portfolio, should it continue for a year, will outperform the S&P 500. Because 15% is a really small tax bracket to be in. And that's it for the analysis, everybody. To conclude everything, currently he's outperforming the S&P 500 on a pre-tax basis. And on an after-tax basis, if his portfolio got taxed at 15% or higher, the S&P 500 will likely outperform his portfolio. And that's what leads me to believe that his current portfolio is in underperformance. Also, keep in mind that it is amazing that he dropped this spreadsheet for everyone to look at. But we would like to see some improvements. It would be nice to know when the contributions are made, so that way we can figure out how they were compounded, or if they were compounded. And we would like to see a tax basis. Those two things combined would make for a great representation for people to learn from. With that said, I'm going to move into the Excel sheet, but for those people who don't want to watch that, I just want to thank you for your time. I hope you like, subscribe, hit that notification bell for more quality content coming straight to you. I have so many things in the pipeline ready for you guys. I'm so excited. I have 6 and 7% savings accounts rates, why rates aren't what you think they are, what the rates actually mean, more about my journey and my progress and how I got to here and what I do, my performances. I mean, the list goes on. Thanks everyone for watching, and let's get into Excel. Okay, everybody, this is the Excel sheet that I've been talking about. Notice it's in Excel. When he drops the link, it's a Google Sheets document. Also, when you open it up, there's a bunch of blank rows above cash balance. And personally, I just found them distracting, so I deleted them. The first thing we want to notice is they began the investment account on 6/16/2020. Today, 7/28/2020. That gives us just over a month of analysis, and that really doesn't tell us too much. It could have been luck, bad luck. It could have been skill, but if it's over a month, we really have no longevity and no consistency for us to pull data from. Moving on, you notice that the starting value was $100 and the additional value added is $25. And again, I talked about it a little bit before. We don't know when this was contributed. I didn't even see any contributions made in the listing here. And the cash balance is well over $25, so it's really hard to determine when. So I do the intrinsic way of measuring opportunity cost and say that it happened on the very last day and that no compounding was made. That'll give them the greatest rate of return. Even though the contributions are only made in Webull and Robinhood to the sum of $75, which is a small fraction of his overall performance. So it's not like it really matters in this scenario, but in other scenarios, it makes a huge difference. So let's dive over to Robinhood. Robinhood, about the same, 500, additional value added 50, same 6/16. Every single account here was made 6/16/2020. They didn't sell anything. You can keep going over here for more information, but I'm not going to belabor over this. You guys can go over this. Here's the Travalia investment I was talking about. What's nice about this is he's got the cost basis and the market value. So to figure out the rate of return, I take the ending balance minus the beginning balance, all divided by the beginning balance, and convert that to a percentage, and I get 189%. I know I said 200%. I rounded in his favor in the previous section, but it still isn't 718%, which leads me to believe it's a different portfolio he was talking about. But I mean, I'm not going to argue with 189% return. I'm not a crypto guy, so this is all foreign to me. Then he has his TD Ameritrade, and this one he started with 100,000, no deposits. The big thing I want to notice is that he has some investments that he sold or some that closed, and he listed the amounts over here, and that's important. What do you do once you have all that information? Well, I created a tab to show you. I have the starting amount, any additional value, and the ending amount of each of the 4 portfolios. What we're going to want to do is figure out what rate of return on a day-by-day basis would cause an investment to go from $100 to $125.78 with $25 thrown in at the end that did not compound. To do that, we are going to create this column, called the Webull equivalent. On the 15th, I had $100. That was in the Webull account. Then I'm going to take that $100 and multiply it by 1 plus our effective rate, which is the daily equivalent. Okay, I'm going to hit F4 so that way it stays in place as I drag it. And I'm going to drag it all the way down to the last day where I picked up this spreadsheet. Now at the very bottom, I'm going to put the ending amount, which was 125.78, because that's our goal. And the second to last cell here, I'm going to add the $25 amount. Notice how the 25 didn't account for any compounding. It was just thrown in at the end. Okay. Now what we're going to have to do is a feature on Excel called Goal Seek. I hit Alt-A-W-G. One of the faster ways to do it. In case you haven't picked up, I love keyboard shortcuts. So if you guys have any questions on how I did something, feel free to put a comment down below. But for now, I'm going to continue. I'm going to set the cell of the last amount equal to the ending balance that we know it is by changing that daily rate. And Excel is going to say, it's going to run its calculations, guess and check style, and it's going to figure out what rate would cause it to do that same performance. And it looks like it's 0.0204 blah, blah, blah %. And just because it's easier to see when I annualize it, I'm going to do 1 plus the rate, raise the power of 366, which is how many days in this leap year, minus 1. So the Webull equivalent made 7.77% a year on equivalents. To do opportunity cost investing, we need to find what the benchmark would have performed. Now, if you didn't know, we don't have how much $100 would have transpired into in that same amount of time. So what you got to do is download the S&P 500 total return data. And for those who don't know how to do that, I did a previous video on how to get that information, which I'll put in the description below. So what we're going to do is find out what the ending balance would be. S&P 500. Well, the first day we had $100, and now we're going to do 100 times 1 plus the change in rates. To find the change of rates, we're going to do the ending balance of the actual S&P 500 total return minus the beginning balance divided by the beginning balance. Okay, we got $101.90, and we'll drag it all the way down to the end, and we'll find out that we have to add the $25 of cash. If we invest in the S&P 500, we would have $130.66 in theory. Remember, the S&P 500 isn't exactly like putting your money into Vanguard because there's expense ratios and they don't exactly mirror it, but you'll get super, super, super close. Here's what we're going to do. The same equivalent test that we did for Webull, we're going to do it for the S&P 500, because even though this middle column here gave us how much the S&P 500 would have as an ending balance, it doesn't give us the effective rate of return, which we're going to find out. So we're going to do the same thing we did for Webull. Equals 100 equals 100 times 1 plus an imaginary effective rate, which I have to F4. Okay, and then drag it all the way down, add the 25 at the end. And now we do goal seek. Okay, I'm going to set the value of the last day equal to 130.66 by changing the effective rate. Okay, and again, Excel did that for us. I'm going to annualize it, so it's just easier for us to see. And it's the equivalent of making 69.95% in 1 year. All you have to do from here, well, I don't want to say all you have to do, there's a lot you have to do. From here, what you're going to have to do is copy and paste that same process for each of the portfolios. I'm not going to bore you by doing that all in front of you, so I'm just going to jump ahead to what that would look like. Now on to figuring out the overall performance of all the platforms in the portfolio entirely. I made this table ahead of time that has all the trading platforms and the totals, the starting amount, the ending amount, periodic rate of return, the weight, and the weighted rate of return. So first, periodic rate of return. we're going to take that effective rate, 1 plus the effective rate, which we find over here, raise it to the power of how many days that this compounded to find the rate in the period. To do that, I'm going to do date diff, and date diff is a formula that's built into Excel. I didn't download anything. It just doesn't come up. It's just an old formula, but trust me, it's there. Beginning date minus the ending date, and you're going to do the metric by which you do the difference in the time periods, which is D for days, minus 1. And you can find out in that period, the rate of return for Webull was 0.78%. Okay, so you're saying that account made 0.78% in that period of time. Well, according to asset allocation, you want to figure out what percentage of your overall portfolio made 0.78% and add those together. So we got to find the weight. Webull was $100, and the overall portfolio was $110,600. That means its weight is 0.09% of the overall portfolio. I did that for the other platforms, as with the periodic rate of return, so we don't have to keep doing that. To find the weighted rate of return, all you do is multiply the two. The periodic times the weight. You get 0.00. And we get 6.43%, which is accurate, and I like it. And the way we can double check that is because we didn't do any money weighting, this will work. But if we had any money weighting, which means we had contributions that did compound, it would not work. So what you could do is just the ending amount minus the $75 we threw in at the end, minus the beginning balance divided by the beginning balance, and you'll get 6.43%. And see how they add up? That is beautiful. I love it. So just to test that out, because I love triple checking everything, is 1 plus this rate, 6.43, times what we had in the beginning, means that it's 117,711.49. Okay? And why does that look different than 117,786.49? Because I forgot to add $75 and I decided to make a lesson out of it. There it is. It's the same number, which is good. Now, just for kicks and giggles, we're going to annualize this amount. This is a pretty complicated equation because we have a weighted rate of return that's in a certain period. So we got to break it back down to effective and then build it back up to a year. So what I'm going to do is 1 plus this rate raised to the power of 1 divided by the date diff again. Date diff of, I'm going to go all the way to beginning, minus the end by the metric, which is days. Okay. And now I'm going to raise all of that to the power of 366 minus 1. And it's going to tell me I messed up because I forgot to put in end parentheses. No. Hang on. I messed up because I didn't put an end parentheses. Yeah. I'm just going to 82.25%. Yeah. All right. So that's how much the portfolio performed. And you can see that all the numbers make sense to each other, and it makes your OCD feel great, or at least mine. We're going to do the same thing for the S&P 500 so we can compare the two. So the ending amount, I don't know it off the top of my head. Oh, 130.66. I lied. Okay. The periodic rate of return is going to be the same formula that we did. 1 plus the effective rate, which was 0.15. Boop. Raise the power of how many days, which I'm going to tell you right now, I know it's 37. Minus 1. Oh, I guess it was 38 days. I lied to you guys, I'm sorry. Okay, and you'll notice that all of them are 5.66%, which makes total sense to us because they were all within 70% in a year. And as time progresses, you'll see a greater divergence. 5.66, which means at the very end, we would expect to see 5.66 as the overarching performance. So that's another way we can check our work. Okay, we're going to find out the weight of Webull, which is 100 out of $110,600, 0.09%. It should match this, which it does. Good. The weighted rate of return is going to be different because we have $100 in Webull making 5.66 or 5.66% on 0.09% of our portfolio. Okay, we add all these together and it's 5.66%, which annualized is 70%. And again, we can double check that if we really wanted and do the beginning times 1 plus 5.66 plus 75. And see how they're the same number? Awesome. And that is it, everybody. I hope you got a kick out of this. I hope you learned a lot. I put a lot of time and effort, so if you could like and subscribe, share with your friends, I'd truly appreciate it. But until next time, and thanks for watching.